So overall, I think we're not at like bear market depths of, like depression, but we don't have characteristics of multi-year tops. And I look at other things. I look at like the age of coins moving on the network. I look at Bitcoin in relation to what's going on in macro. I look at the MNAV, so the market value to net asset value of publicly traded Bitcoin treasury companies. Nothing right now is indicating extremely high froth levels. I think we're more in like a mid-market type territory.
The cryptocurrency market today sits in a zone of uncertainty, neither marked by the extremes of speculative mania nor the distressed valuations of past cycle bottoms. Amidst muted volatility and subdued inflows, many investors are questioning whether the current cycle has already peaked. But to understand where we are in the Bitcoin cycle, it's critical to zoom out, beyond price action, and examine the structural forces shaping this market. Lyn Alden, a leading macro strategist and founder of Lyn Alden Investment Strategy, provides that long-term lens. In a recent interview, she outlines how the United States has crossed $100 trillion in combined public and private debt, a level of leverage so deeply embedded in the system that it leaves policymakers with little choice but to continue monetary expansion. Historically, total debt levels in the U.S. have only declined in 5 isolated years: 4 during the Great Depression and 1 during the 2008 financial crisis, quickly followed by aggressive money printing. Today's environment, she argues, represents the next phase of a sovereign debt cycle, a slow, grinding transfer of value through inflation and monetary debasement. At the same time, Alden points to the erosion of U.S. reserve currency dominance, noting that no other nation is poised to replicate the post-World War II American superpower model. Instead, she sees a shift toward a multipolar world, one in which neutral reserve assets like gold and increasingly Bitcoin gain prominence. Within that backdrop, Alden is not calling for a crisis, but a gradual realignment, one in which those structurally positioned on the right side of monetary expansion benefit, while others are silently diluted. And this macro framework shapes her view on Bitcoin's current position, not at euphoric highs nor at bear market lows, but mid-cycle, supported by fundamentals and macro tailwinds, yet overlooked by much of the market. Before we hear Lyn's breakdown, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks, and enjoy the video.
Yeah, so one thing I covered in that presentation is that we've crossed over 100 trillion debt, which includes public and private debt. So that's kind of total debt in the American system. It's obviously higher than that when you look at globally. One of the things I pointed out too is that the number of years that they've ever gone down is extremely low. So in the entire kind of period that we've been alive, and even our parents have probably been alive, the total debt in the U.S. only fell one time, and that was 2008 during the global financial crisis, and it only fell by 1% before they started money printing. And if you look at the longer data set, going back all the way to the creation of the Federal Reserve over 110 years ago, there were 4 other years where total debt went down, and they were all in the Great Depression, so 1930 to 1934, and then that got too painful for them, so they printed. And so 5 years out of the over a century where they ever let that debt fall, because the way it's currently structured, central banking with fractional reserve banking built on top of it, and then debt securities built on top of that, it kind of has to keep increasing or it runs into issues because it's so incredibly levered. When it gets levered 20 to 1 or 50 to 1, as it normally is, 50 to 1 being at those kind of peak periods, they don't really have any ability to ever let that even unwind a tiny bit, because even a small unwind is like bigger than the monetary base, and so they're pretty quick to pull the money printing trigger. As for how bad it's going to get, so we're already past kind of the private sector deleveraging peak. So the 2 times in American history where that happened were 1, the Great Depression, so early 1930s, and 2, the Great Recession, the global financial crisis of 2008, 2009, and the few years after that. And now we're more in the public debt cycle, which is that more debt is transferred to the federal level. Basically, I view it as more of a long grind than an event. So, for example, I'm not really calling for a crisis in the next handful of years. I mean, who knows what can happen with war or geopolitics? But aside, not putting that stuff aside, in terms of just the U.S. money system, I'm not really looking for crisis. It's more like positions that are currently disadvantaged are going to continue to be. and ones that are currently advantaged are going to continue to be. And so basically, if you're on the right side of those deficits, it generally feels pretty good, and people wonder why are people complaining? What's the issue? And if you're not on the right side of those deficits, you're getting squeezed pretty hard because you're getting all the debasement associated with those deficits, but you're not on the receiving side. So you're getting diluted. There's kind of this value being transferred away from those people and toward others in a fairly opaque way. So how bad it's going to get depends on how either fortunate or unfortunate you are in the stack, and then also what you're doing, be aware of it, and then protect yourself from it.
And what do you think could happen or will happen if the US as a nation is going to lose their reserve status?
Well, I think that's more of a process than an event. If you kind of point to when did the UK lose their reserve currency status, there's a couple milestones that were important, but none of them were like the day. And so there was a period of time where the U.S. surpassed, the biggest economy in the world. Um, then Bretton Woods moment was obviously a huge moment, but the UK debt was still pretty widely held. Then there was the Suez crisis, where the UK lost political clout, and then it's really been a long grind of losing it ever since. There's still a reserve currency, they're still in the top five of like held currencies, but not very much. And they've never had this kind of massive crisis because of it, but they've had a deterioration in their global standing and kind of the aftershocks of that. So I think that the U.S., by some metrics, we already hit peak U.S. dominance, which is you can look at, say, U.S. dollar share of global reserve assets. You can look at U.S. Share of global GDP. There's a couple of different metrics you can look at. Whether or not the U.S. is the biggest trading partner with most countries in the world or not, we've lost that to China. And so I do think we are over our hump. We're over our peak. But I think there's this kind of like long tail that goes forward. In addition, people, when they think that, often assume that another currency has to replace the former currency. But historically, that really only happened like one time. For most of history, kind of modern history as we know it, gold was really the global reserve currency, and the other currencies were just these like overlays on top of that. They were instruments that were generally backed by gold or backed by silver in some cases, and it was whatever the kind of the country that was exploring the most, that was kind of this biggest growing economy, and therefore the most recognizable. And as they would kind of expand and then contract, and some other entity would take over, that would kind of displace them. But ultimately, it was gold for gold and silver for most of that history. We did have a handover where the UK went to the US as a global reserve currency, but people often assume that the US has to hand it over to someone else, like China or whatever the case may be. I make the argument that this period was an anomaly. This isn't something that's going to keep repeating. This kind of U.S. dominance period was an anomaly. So after World War II, the U.S. was over 40% of GDP. Most of the world was destroyed. The U.S. had by far the most gold, biggest manufacturing base, really strong demographics, by far the biggest military. The homeland was mostly unscathed by the entire war. And so it was just like a hyperpower position. And so everything was kind of built on top of that. And over time, we've fallen from over 40% of GDP to 15 to 25%, depending on whether you're looking at nominal or purchasing power parity GDP. We're no longer the biggest trading partner. And so as you kind of go by different metrics, we've been shrinking. But there's really no other currency block that's going to recreate that 40% of GDP hyper dominant situation. And if anything, that's a healthy thing. That was an anomalous period where like most of the rest of the world was destroyed. And if you look at kind of long run history, like China and India used to be pretty big percentages of global GDP, stretching back a very long time. But in the era of kind of Western exploration and colonialism and stuff, they were on the wrong side of the technology war that happened. So they radically shrank as a percentage of global GDP despite their large populations. And if anything, the recent return of India and China to rather large chunks of global GDP is back to the normal state of affairs, given the size of their population and the long-standing history of their cultures. So I think we're entering a more multipolar world is kind of the punchline after that long ramble I just gave. We're entering a more multipolar world, which generally means two things. One, neutral reserve assets reassert themselves in the system. So the biggest one would be gold, but obviously Bitcoin's a newcomer with a lot of really attractive characteristics. And it also means, to the extent that fiat currencies are held as reserve assets, there could be more diffused holding of them. So rather than one being, say, 70% and like the next four making up the other 30%, You might have the top one be 40% or 50%, and the other four make up, the rest of that, or the other nine top ones make up the rest of that. So you have a more diffused currency base.
As we assess Bitcoin's trajectory, a critical distinction is emerging in how different classes of capital approach it. While retail investors and institutional asset managers continue to drive price discovery, a more strategic, long-duration form of capital is beginning to take notice: sovereign wealth. Unlike central banks, which prioritize liquidity and low volatility for reserves they may need to deploy during crises, sovereign wealth funds operate with different mandates. Their portfolios are built for long-term capital preservation and growth, not short-term stabilization. This matters because Bitcoin's volatility, which makes it a poor candidate for near-term currency defense, becomes less of a barrier for capital that's looking 10, 20, even 30 years ahead. For these allocators, the asymmetric upside of Bitcoin, combined with its growing liquidity and maturing regulatory profile, makes it increasingly viable as a small but strategic position. We're witnessing the early stages of what could become a multi-cycle structural allocation trend. Creditor nations with strong currencies and multi-generational investment horizons are best positioned to lead this shift, and some already are. This is not yet a full embrace of Bitcoin as a reserve asset, but it is a meaningful pivot, from speculation to long-term strategic integration. And if this trend accelerates, especially in an era of declining trust in traditional monetary systems, it could be one of the defining drivers of Bitcoin's next phase. Let's now go deeper into what that would look like, as Lyn Alden breaks down the reserve asset versus sovereign wealth use case, and how Bitcoin might scale into both over time.
The earlier phase, and we're seeing early signs of this already, is sovereign wealth fund investment. And the reason that distinction matters is because a reserve asset, something held by, like, say, a central bank, is meant to be there when you need it. If you need to, say, one or two things: either you sell it to buy back your own currency to strengthen your currency in a currency crisis, or if, like currently, there's a lot of dollar-denominated debt in the world. So there are banks and there are corporations and governments around the world that have dollar-denominated debt. And in a dollar shortage, like let's say, for example, when pandemic lockdowns happened and all the global trade dried up and all the dollar flows contracted, but these debts were still owed, having dollars at the sovereign level in some way is useful because then they can loan them to their domestic entities that owe dollars and keep their debts solvent. So either to backstop the currency or to backstop their offshore debt liabilities. And so that's generally a large liquid asset like gold as a reserve asset, or more commonly, dollars and treasuries. Bitcoin being small and generally also being something that there's not a lot of liabilities denominated in, it's less going to be picked in the near term by central banks because they can't say, look, in 18 months from now, if we have a currency crisis, if Bitcoin's cut in half relative to what it is now, that impairs our ability to defend our own currency. The volatility is kind of too much for that kind of reliable need that is required. And instead, where we find it is creditor nations have big sovereign wealth funds. And these funds are not meant to be used in emergencies. They're not meant to be time-specific moments to backstop a currency. If anything, their currencies are very strong because they're major creditor nations, and they've intentionally weakened their currency in many cases. And instead, they're saying we want to build sovereign wealth for the next 10 plus years, and kind of backstop our citizens' retirement or our sovereign ability to maintain dominance, whatever the case may be. And that's where we're seeing Bitcoin show up. So it's not really earmarked for any kind of intermediate term purpose. And I think that makes sense for where Bitcoin is at this stage. So as a $2 trillion volatile 16-year-old asset, I think that makes sense. So I think we'll see it more and more in sovereign wealth funds. And then, one day when we add a zero to its market cap, hopefully, and it's way more widely held and less volatile, I think that's when you can see it show up in as a reserve asset as well, because at that point it has gold-like characteristics or treasury-like characteristics, where it's this large, liquid, highly understood asset that is there to be sold kind of rapidly when needed. There are a couple of things I monitor for signs of bubbles. There's no like one killer metric that can tell you if it's a bubble, and also you don't even know when a bubble is going to peak. I mean, a bubble could turn into a bubble twice as big before it rolls over, for example. That happened to a lot of people in the dot-com bubble. It was like They were looking at the market in like 1998 and think this is pretty frothy, and then it's like, well, you haven't seen how high it's going to get.
Yeah.
Um, but I look at my favorite metric is market cap to on-chain cost basis. Basis, okay, what is Bitcoin market cap? That's easy to measure, price times supply. And then you look at on-chain cost basis, which is basically pricing every coin at the time it last moved on-chain, which statistically mostly means the time it went to or from an exchange. Those are the biggest moments for that metric, and that creates kind of a psychologically important number. It's also basically it's kind of like volume adjusted market cap in a way, because and the analogy I use, if you have 20 houses on a street and none of them have sold in a few years, and one of them sells for double the price that it last sold at, you'll generally see that all the other homeowners mark up their real estate at to the level that that new one sold at, but that's the liquid price. That's like, 5% of those houses moved and the whole street's now twice as valuable. But it's not clearly the case that if 10 of those were to sell, they would all sell at that higher price. And Bitcoin's obviously a much more liquid asset than that, but there's still a part of truth to that, which is if you get a really quick price move to a new level, if it does start to unlock a lot of existing supply, that price is not necessarily maintainable at that new high level in that window. But if it kind of reaches a price level and then spends 6 months or 12 months or 18 months chopping along at that level for a period of time, and the cost basis goes up and a lot of volume and a lot of liquidity has occurred at that new level, then that's a more meaningful liquid kind of price level for the asset. And so during prior multi-year peaks, we can call them bubbles, I suppose, because you kind of had a few years of a bear market afterward, they hit very high levels by that metric. Currently, we've not hit anywhere near the levels that are historically associated with multi-year drawdowns. There are times we hit, I would call it moderately frothy. So, for example, in March 2024, which was the near-term aftermath of the launch of the US spot Bitcoin ETFs. So there's a little bit of a fervor there, a little bit of a rapid price jump. We briefly touched new highs at something like 73,000. And that metric got a little bit frothy, but it was nothing like one of those, multi-year periods. And then we did end up consolidating for like 7 months, which makes sense given the moderate froth we had. Then, shortly to your point, right after October, when we had an election in the U.S., a much more favorable environment to Bitcoin. That was kind of a catalyst, but that was after a 7 month consolidation. We were in a pretty good space valuation-wise. We jumped up to, what was it, 107,000 or 108,000 thereabouts, and that reached similar levels of like moderate froth. Again, from November until April, May, we were in this consolidation phase, which makes sense. A multi-month consolidation for a little bit of froth. We eventually worked past that. We've touched new highs. We pulled back a little bit. So overall, I think we're not at like bear market depths of like depression, but we don't have characteristics of multi-year tops. And so I look at other things. I look at like the age of coins moving on the network. I look at Bitcoin in relation to what's going on in macro. I look at the MNAV, so the market value to net asset value of publicly traded Bitcoin treasury companies. Nothing right now is indicating extremely high froth levels. I think we're more in like a mid-market type territory.
Lyn Alden doesn't believe we're in a late-stage bubble. Far from it. According to her analysis, we're still in the middle innings of Bitcoin's bull market. One of the most important metrics she watches is the market cap to on-chain cost basis, essentially comparing Bitcoin's current total market value with the aggregated cost basis of all coins on-chain. This gives a clearer picture of how much of the market is sitting on unrealized gains, and whether sentiment has reached unsustainable levels. Right now, that ratio isn't even close to the extremes seen during previous cycle tops, like late 2017 or early 2021. Instead, we're hovering in a moderate zone. Frothy at times, like during the ETF launch in March or the post-election rally in October, but followed by healthy consolidations that reset the market. Alden also references metrics like coin dormancy and coin age, indicators of whether long-term holders are selling into strength. The data shows they're not. In fact, much of the supply remains tightly held, even as prices move higher, a key characteristic of sustainable bull markets. She further points to macro and structural forces, rising adoption, improving liquidity, favorable fiscal conditions, and a gradual onboarding of institutional and sovereign capital. All of these form the foundation for what she sees as a durable price appreciation phase, not a speculative spike. In short, the volatility we've seen isn't a sign of a peak. It's evidence of a market digesting gains and preparing for another leg up. If history is any guide, the real blow-off top and the metrics that typically signal one are still ahead. This is not the end of the Bitcoin bull run. It may just be the beginning of its most transformative chapter. If you found Lyn Alden's analysis as insightful as we did, don't just watch, join the conversation. Do you agree that Bitcoin's best days are still ahead? Or are there risks you think the market is underestimating? Drop your thoughts in the comments below. We read everyone. And if you want more deep dive content like this, make sure to like, subscribe, and turn on notifications so you never miss a market update. Thanks for watching.